The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Good Friday afternoon to you. Wonderful to be here with you. I'm Nadine Blaney for The Call. 10 companies picked by you, 2 expert guests, 2 stock of the days today, all in the course of 1 hour. It's Friday, the 6th of May, and I am so pleased to welcome to our Barangaroo studios, Jun Bei Liu from Tribeca Investment Partners and Adam Dawes from Shaw and Partners.
Yes.
It's been a long time since we've had this threesome together.
Absolutely, it's very exciting.
It's a good day. Oh, it's not a great
not
day,
a good day.
is it?
Yeah, but
It's
anyway.
pretty tough out there right now. Look, I'll timestamp this for those of you listening on the podcast, but we are 12 noon here in Sydney on this Friday afternoon, and the local market is down by 2.5%. So, pretty tough times out there, and that is the context in which we'll be discussing a number of great stocks today. Elmo, 7 West Media, news associated with both of those companies this week, EM Vision Medical Devices, Worley, and ASX. I don't want to waste any time, so I'll get right to the stock of the day. Now, a bit of Friday vibes around here. I did ask earlier this morning on air what you'd like us to see covered for the stock of the day. I said you could tweet to me. I also got some emails as well. And so I thought it was pretty tough to pick between these 2 stocks, so I figured we'll just do them both. First up, Macquarie, posting a 56% jump in annual profit, benefiting from commodity price volatility. Earnings from the capital are more than tripled to $2.4 billion. So why don't we start with Macquarie? Because it's surprising, I think. I know it's a bad day out there, but to see the company down by 6% at one stage of the game, 8% now. Jun Bei Liu, was it the caution that the company expressed about the overall economic outlook? Does it warrant an 8% fall?
It doesn't warrant 8% fall. What's happening is, aside from all the other stocks that's being sold off in that sector at the moment, it's really about Macquarie trying to guide cautiously. That's what they always do. So they have just posted an incredible result on the back of some of unexpected event, things like energy crisis and commodity trading has been incredibly strong. So they just want to start a year with a reasonable expectation so that they can beat in the next next 12 months. So the guidance was saying, look, the first half next year is going to be lower. And clearly last year was incredibly strong, and then the year before was incredibly strong. But this is what they always say at the beginning, when they deliver the full year results. And remember last year they have incredible amount of upgrades, and it was also same as following, a somber start to the new year. So look, nothing to be worried about. I think it's an incredible company. Investing in Macquarie is not about buying for the next result. It's about invest for the next 5-10 years. Amount of investment they have put into all their renewables, all these assets that really have, the future-proof their asset pool instead of just traditional banks where you just generate margin in lending and turning. So it's an incredible business. Today was just really a shareholder just saying, oh, look, there will be consensus downgrade.
So is there a buying opportunity in it today? Currently at 186. I mean, when it's under 200, I've heard plenty of times, buy.
Yeah, it's absolutely a buy.
Adam, do you see things any differently? Because, look, perhaps you can get it cheaper.
Well, I mean, that's always the case. You can get it at $0 maybe one day or two, but it will never happen that way. That's very tongue-in-cheek, everybody. Look, Jun Bei, I would really hope that the market would actually be aware of what Macquarie does on a regular basis. We all know that they always come out.
Well, that's my point too.
Then, and now you get this big hit.
Under promise, over deliver.
Yeah, and they always do that, and it's a buy from me, everybody. Absolutely, I think it's a fantastic business, and I'm really, really comfortable with it. I just feel that the market's overreacting, and obviously with the US, it's just exaggerated that fall. Maybe they would have only done a sort of a 2% fall, but it's down. What did you say? 8%.
8%.
So
you don't see Macquarie Group down 8% very often.
It's a big fall. But if you look at some of the numbers, I think it's absolutely their common tier equities at 11.5%. I think that's fantastic. Their ROE is now back up to 18. I mean, that's getting close to really sort of real fantastic businesses, and they've got surplus capital of $10.7 billion, up from $8.8 billion the year before. So times have been good. We always knew that the commodities were going to do well. Potentially a little bit of cooling coming into this one, like Amcor the other day. Like it's already rallied so hard, and there's people just taking a bit of profit. But I think it's a buy. Anything under 200, I'm really comfortable with.
Okay, so that is a buy. So there is no hint with either of you that the best days for Macquarie are over, or
not at all. Not at all.
Yeah.
They
know
always
what they're doing.
They exactly, and they invest for the much longer term, and you don't buy it for the next result.
Yeah. So we've already got a double buy today. Let's get to Atomos, because of course it's on the smaller end of the index, but a lot of our viewers have been following this company very closely for a couple of years. It did confirm guidance for FY23 and 24, but warning that sales have slipped so far this year. So it's out with a trading update. Pretty much it was a profit warning. So what do our experts think? Adam Dawes.
So why did you pick me first?
Because on the 8th of April you had a buy on Atomos, and I know it's the house view at Shaw Partners. Look, you're not alone.
No,
so
I know.
There's nothing in it. But I mean, how does a shock? I mean, obviously it's a shock downgrade when you've got the share price down by 40%. What's up?
Look, obviously profit downgrade in this environment, and this is a growth company, and if you disappoint the market in any sense of the word, it will be very, very harsh on this one. The stock's obviously continuing to fall. 36 cents. I think it had a low of 30 today. So it's certainly one of those ones that has been hit hard. Obviously, earnings forecast and significant downgrade to sales has been the big thing. They're talking about marketing and how they're having to spend. And you were saying something about the MD leaving or something like that as well?
Well, it was recently there was a change in CEO at Atomos. So is this now, repeatedly indications of something's going on there?
Correct. Yeah. Correct.
So do you sell now?
From a board level, I think that there is definitely something going on, and if you see the MD leaving with no real succession plan going forward, then you know that there's something happening, and then potentially today is obviously a clear indication that there's something going on. Do you sell today? Look, this is a great little business and has done very well because it does take advantage of a lot of technology that people have from their iPhones and everything else. Like it's a great technology. It's a hold.
I guess you're going to wear the pain now.
Well, yeah. What can you do down here? I mean, unless Jun Bei is probably going to disagree.
Well,
but,
unless you have I guess unless
no,
you've really
fundamentally,
changed your view.
no, I think the skeletons in the closet. I don't think they're all out yet. Okay, so we've seen one profit downgrade. We've seen a management change. There's probably another downgrade to come along here, and then that's probably the time to buy. But I think if you've got some, I think you'd be okay to hold because the technology is there, and tech has been getting absolutely.
Yeah, the market is in no mood to tolerate any sort of bad news.
And the reason why tech's getting belted is because everyone was willing to pay 100 times for these businesses. Now they're only willing to pay 30 times for these businesses, and the value is now coming back down. So potentially at 30 cents, somewhere around there's some value in some of these things, but I don't know when the bleeding stops. So I'm going to say hold.
It's interesting. So in this trading update, it's got a lot of detail about a response to its new products. And it's saying that after considering feedback at NAB, which is a big tech conference, saying the company intends via promotional activity and discounting to rapidly increase its installed base of cloud-enabled products to further optimize take-up of its new cloud services. But it will have that short-term earnings impact. Confirming, and it should say, annual recurring revenue guidance for FY23 and 2024. So it's tough, isn't it? It's coming out, it's acknowledging all these issues. It's not been selling. Is the basic takeaway, though.
Well, that's exactly what they're saying. I'm sorry, we can't sell enough products, so we have to discount and sell them.
Yeah.
Look, for a share price to be down more than 40%, it's angry selling. It's not really reflecting of the fundamental or anything else. Someone just lost faith, or group of investors lost faith, just want to sell it. Now, I don't blame them because if you look at what's been happening, so they had previously had a CEO and he left, and then they appointed a new one, and then she only just stayed for a very short while, and then she left a few weeks ago, and then at the time board reaffirmed the guidance, and then now just a few weeks later, and then they changed the guidance. So it's very difficult for external minority investor really to work out what's happening. Why has things changed so quickly, and why did she really leave, and whether there's anything in the closet. I think this so at this point I feel this stock is either a buy or sell. So the question is how easier to pull the sell trigger, because just because we don't know, we can't lift all these the lid to see really what's there because we're outside the business. And like Adam said, there could be another downgrade or maybe the company's not on top of it. So we need to know more, and that is company need to give more explanation, more transparency and clarity of really what happened, rather than we can't sell enough products. Sale can't have just dropped in the last couple of weeks.
No, but you said it's either a buy or a sell. So let's just put the question out there. Would you be buying this to put into your portfolio?
I would be selling it today.
Yeah. So you would sell if you were a holder because the bad news might not be over.
That's right, and it's too unclear to really work out what's happening.
Got it. Thank you, guys. So that is 2 stocks of the day. Let's get to the companies that have been nominated by you, our viewers. Thank you as well for getting those in. And remember, this is information only. It's not financial advice. This is for Max. Elmo Software. Again, software is a tough business to be in right now in terms of market reaction. What do you think of Elmo, Jun Bei?
Look, I think Elmo, again, as you said, it's a tough space. It's because the company is still burning a lot of cash. Any company or any sector that's burning cash is going through a very tremendously difficult period because money costs more, just costs more to really raise and and to really spend. And do they have access to all these capital? Now, this company, it has done quite well in Australia in the HR software space, and then just reached that kind of tipping point where it possibly can be, get the scale benefit within Australia. But they continue to invest very strongly and just recently expanded into new market. So it has yet to demonstrate to investors that scale, sort of leverage will come through. And just given the amount of investment, it's, the significant investments committed to, I think it's a very challenging space. I'll be avoiding it for now.
Even though it reiterated its FY22 guidance for annual recurring revenue, which was at the top end of guidance, but that is Jun Bei's view on Elmo. What's yours?
I'm going to go the other side because we cover this stock and we've got a buy on it. So I'm going to stay with my analyst on it and stick with the buy because of that. The top end guidance for 2022, they did reiterate it. Annual recurring revenue did decline a little bit. So that's probably where the market is getting a little bit more concerned about what's going on. But certainly overall, strong operating cash available in there. They're expecting their fourth quarter to continue, and they are spending a lot of money. So you need to do that with your tech side of things. I think all tech's getting thrown out at the moment, and there is going to be huge value that is being now started to be created on this. They are looking for EPS growth in 2023. It does sound like a long time away from here, but they are looking for EPS growth of around 22%. So I think there's some bargains down here for this one. Most tech stocks are getting hit, so there's got to be some kind of rationalisation sooner or later. And I think Elmo's in the boring side of tech, HR, cloud computing, that kind of thing. And that's probably where you could probably start, and then we could look at the higher stuff and the more riskier stuff later. So I'm going to stay with my analyst, and it's a buy. Okay. High risk.
High risk.
High risk.
Yeah, I was just sort of reading over some analysis from RBC Capital Markets. They've got an outperform on the company as well, just saying that it does see growth coming through. So that's Elmo Software. You had a sell on that, correct?
That's right.
Yeah. Avoid. Let's get to Seven West Media. So here's a company, a lot of these media companies, again, are looked upon as pretty boring. They're very cyclical. We all know that. But right now it seems as if they're in a bit of a sweet spot, doesn't it?
It does with election coming up. They should be doing really, really well with the amount of ad spend that's going on at the moment. But the problem is that's not really flowing through to the bottom line, especially with Seven West and NEC or Nine.
I should say this one's for Jack. He's considering jumping in after the positive update that came through this week. We heard from a lot of these companies at that Macquarie conference. Nine, to your point, mentioned as well that things are looking good and upgraded its guidance. Yeah.
So it's an avoid for me. I don't like media companies at all.
I find that a bit insulting, but we'll move past that.
Nothing on ausbiz, but media companies for me, they've done really well with the streaming side of things and the 7 Plus and all that kind of stuff that they've got, that sort of extra media that they've put on. But really at the end of the day, it's all about advertising, and advertising's been really, really tough. The reopening trade, yes, that's happened as well. But for me, Seven West Media and Nine are both avoids.
I'm on the other side on this one.
I love that you guys are not agreeing about everything.
Well. You haven't seen each other for a while.
We
haven't spoken for a while.
We didn't plan.
Yeah, that's right. So with Seven, look, I always believe everything has a price. So, with Seven West Media, you're not really paying much for its earnings, really. You're probably paying 3 times. Expect the current earnings to continue 3 years. That's all you're paying. We know the TV is structurally challenged and things. We've got streaming, we've got everything else. So Seven is very much exposed to that. However, we last few years we have had really tough the ad market, and then TV has come back in a big way. Not only it's coming back because it had really tough time, it's coming back also because consumer has spent so much money on buying goods and everything, and then the corporates and sitting on so much cash have realized that they need to invest to keep that consumer engagement. Online companies, offline companies, everyone's spending. So we have seen some of those TV spend incredibly strong, and aside from election, and election normally benefits the TV really well, which we're already seeing some of those come through. Yes, costs are higher, which is across the board. We're seeing high costs across pretty much all the corporates. But for these guys, when the demand is strong, you can start charging on the spot rate, right? You start charging, you have a bit more visibility, higher prices will benefit for them for the time being. It's enormous amount of cash flow coming through for this company. I think eventually it will get taken out, just simply because it will sit better as part of a bigger group, where you get more leverage, cross-media platform sale. But at this point, clearly it's sitting individually by itself. It is generating a lot of cash, and you're not paying much for it, and the operating environment is very, very strong. So I think it's a buy.
Yeah, and they've taken the cost out of the business already. They were sort of pre-inflation taking cost out of the business out of necessity. Got it. All right, next on the list is for Linda. And this always, always sort of, well, I'll let the question stand for itself. So EM Vision Medical Devices, EMV is the ticker code. Linda says she likes the biotech space. This popped up on her radar after its announcement with Keysight Technologies in the United States. So what do the experts think? Do they have a preferred pick in the space? So this is medical imaging. I don't know if you'd really call it a biotech. I haven't done a lot of it. Yeah, it's more med tech. Now, I know that oftentimes the guests say it's binary, you either achieve success through phase 3 trials, but that's very much in the biotech space. Med tech is something very different. So what do you know about this company? What do you think about commercialization of medical imaging and the fact that it's just done this deal?
Yeah, look, so Australia actually has a really, great track record for medtech to do really well, and the likes of Cochlear and others. So we actually have really good track record. And this one, it does seems like it's in an interesting space. It's a good deal, but it does still look like it's early stage for you to really get that kind of scale benefit to sort of see profitability, see clear path of profitability. I look through the consensus forecast. Look, still going to take very many years before you can see any type of earnings flowing through. So for me, that is a bit too long trajectory at this point. And that space in terms of what investors are paying at the moment, are very challenged just in terms of, high multiples, growth companies all being sold off. And that whole space is essentially experienced the same thing.
Yeah.
You agree?
I agree. We might not agree at any of the other ones, but I agree with Jun Bei on this one. For me, so medical devices have a least path to resistance to get FDA approval or to get that kind of approval, whereas if you put something, ingest something into your body or put something into your body, there's huge amounts of money that needs to be spent to get that done. So a medical device is actually quite a good way to generate revenue. But the catalyst is for this one is that the first gen device that they intend for commercialization is great, and the announcement, as the viewer said, around Keysight Technologies in the US is also very good. But the problem is also with hospitals, they don't have a lot of funding, and they usually work on a lot of stuff that's basically old equipment. And so this new fandangle thing comes through, they've got to spend money, they've got to change processes, and it's really, really difficult to get these devices to be used inside of the hospitals, which means that there's got to be a huge sales staff or sales force to go out there and try and sell that, and then there's extra costs that's overlaid on top of that as well. No, so for me this one would be an avoid. I don't see, I would stay within the big end of town, and Sonic Healthcare, CSL, those kinds of businesses, ResMed, bit of a downgrade the other day. So that's where I'd see to look versus staying in these smaller companies with a long track record of not being able to succeed.
Just to give Linda something, go ahead.
Oh, I was just going to add on top of it that, when people at the moment worry about the market, all the growth companies just being sold off, all of them, and people simply don't want to buy anything. I think, if we look to the history, very soon we will see some of the top leader within the growth businesses will start to do well, because as people start worry about the, recession and that type of thing. And then, so you need to then break it down, what type of growth company you want to buy. It certainly is not the ones that doesn't make money. You want to buy the ones that have proven track record, have good, long-term growth, things like CSL, things like ResMed had a tough result, but so what? It was 3-month result, next result will be better.
Correct.
You take opportunity to buy these companies. Don't worry about, it's almost a bottom drawer. You buy CSL, buy ResMed from at this price, in a year's time it will be higher. Whereas if you buy the unprofitable one, like this one, like some of the other unprofitable businesses, it will take longer for you to actually know when that might bottom, because they need capital. We are going through, money's going to cost a lot more. So and if you in the historical thing, if we break down the S&P, the Nasdaq, during the tough times, it's the strongest tech, the Microsoft, all these businesses that actually have good markets, they outperform meaningfully compared to the normal market. So just need to be careful in this market, and it actually does present a lot of opportunity for the growth businesses.
So do you also agree with Adam that CSL or ResMed would be a good buy now?
Absolutely. I think you'd be just buying it today. Don't worry about it. Don't even look at the share price for the next whatever time. It will be higher in 12 months.
Got it. Okay, thank you. Thanks, Linda. Let's get to the number 4 on our list, actually, is Worley for Karen. Look, she's just interested in getting a view on Worley. I suppose there's a lot to take into consideration with Worley. There's a lot to think about in terms of oil and gas production, exploration, margins. You can also talk its push toward more green technologies, and you like it.
It's going to be a table thumper for me, but anyway,
table thumper.
Let's keep going.
Write it down, Nino. Yeah. Tell us why.
Exactly what you're talking about. Oil and gas engineering is fantastic, and obviously it was a little bit on the nose 6 months ago, but obviously now everyone's potentially short, not short oil, but short of oil reserves, and so they're going to have to look for new greenfields. We know that Saudi Arabia is actually absolutely going out and exploring in these large areas, and they need oil and gas engineering businesses to do that. But really why it's a table thumper for me is that green energy transition. We all know by 2030, 2050, there's going to be millions, in fact trillions and billions and trillions of dollars needed to be spent to become net zero. And we're going to have to do that by producing solar farms, wind farms, all of these kinds of things that Worley is now positioning themselves to do that. I think it's around about sort of 3 to 4% of their revenue at the moment. They're looking to grow that by up to 25% of their revenue in the next 5 to 10 years. So this thing is just, and if you look at the chart, it actually looks really, really good. It's just ticking up nicely. There you go. That's the kind of chart that you want. It's going to continue to go forward. I think this could easily get to sort of close to $18. And then continue to move. So yes, it's a buy from me.
It's a buy from Adam Dawes. Will it be from Jun Bei Liu from Tribeca?
I must say I agree on this one as well. On many different aspects, I think this. Look, it's essentially it's a share price very much linked to it's like oil derivative because it's services all these drillers and things. And another thing I love about this business is future what it does, right? It's investing to future-proof its future revenue stream. Now, why is it important? There's a huge amount of ESG focus now across the ASX. Most of the fund managers or most of the institutional investors, we all look at the ESG momentum. So it doesn't have to be the best in class, which best in class across all the businesses, probably literally only 3 companies or 4 companies that we can invest in. Everyone's looking at businesses how they can improve. So if your ESG score, things like future-proofing your portfolio and future revenue stream coming from the green energy, all of that will show rate significantly more positive than their peers. And Worley actually is rated quite highly on that basis. So I do think that future flow into the ESG with that ESG conscious investing will have a lot of money into things like Worley, aside from its current earnings actually leveraged to the upside given the energy prices.
So Worley is a buy from both of our guests. So that will be going to the investment committee, and I'll update you on that in just a moment.
Only thing is, I think that in the short term, so I think they didn't present at the Macquarie conference. They were meant to.
Oh, were they?
Oh,
right.
Yeah. So what would you read that that's a no-show or?
So they pull out. So normally people get a bit nervous when companies do that, but it could be just maybe there's an announcement coming, or usually there's something
COVID,
coming through. So yeah, so just that it could be something coming, could be a downgrade. But Worley, you're not investing for like this result. It's because they've gone through really tough time because lockdown and staffing costs and things. But it's next 12 months, it's looking good.
Yeah, can't see anything on the ASX website referencing its no-show at the Macquarie conference, but that's just good fodder. Nice to know. Speaking of the ASX, that's next on the list.
Nice.
Yeah.
Segue.
Okay. Stock number 5 for Brett. This is the ASX Incorporated, the actual limited company. Okay, please. Now, this is the context. Like to know the long-term potential. I was just looking, and the big brokers, Macquarie is the only one that appears to like it. You got everything from underweight to reduce to sell from Citi and UBS. What do you think of ASX?
Look, it's a defensive company. It's a very expensive defensive company. Normally it grows at that sort of low single-digit growth, and you're paying 30 times for it, and it doesn't, and then it's been almost a monopoly for years and years, and it's been doing quite well, creating different services and generating earnings growth, but that's 2% and you're paying a lot for it. And the issue is now competition is coming in, you've got Chias, got a few other things coming through, and then they're serious. Those competitions are serious. Going forward, does that mean long term they can still grow at that low single digit? Might be challenged. So just at this point, I think it's just a little bit too expensive for what it is. Given how many other quality companies you can buy with much better growth profile and is still very defensive earnings stream, we're talking about CSL and others, far cheaper compared to this, or not far cheaper, but cheaper compared to based on its growth profile.
Yeah, so ASX, too expensive in Jun Bei's view, defensive. I mean, is there a place in a portfolio for ASX when we're talking about competition? Yeah. Chi-X, now called Cboe Australia, they've come in. That's a formidable opponent, and you're starting to see more even, of products being issued and issuances coming to Cboe.
Yeah, and traditionally ASX have been really slow to get products to market as well, and they've struggled with that a lot. I'm with Jun Bei on this one. I don't think you need to be there. It's not an avoid though, because if you hold it, dividend yield is okay. But going into the next quarter and into next year, we are going to see capital raising starting to slow down, and we've already started to see that ECM market really tightening up at the moment. So that's a big part of their overall revenue stream. Equities is going to continue to go. There will be volume going through, but I just don't think people like yesterday. It was a great day, but like it was really quiet on the desk. Like I just think people are getting a little bit nervous and just a little bit sort of, let's wait and see what's happening, and that's just going to transflow into those volume equities as well. They are doing some futures and derivatives, which is fairly good, but that is also a very, it's a hugely shrinking market. We're like the third largest derivatives player at Shores here in Australia, and our market's even shrunk as well. So that higher risk stuff isn't getting traded as well. So unless ASX can come out with some new products, and the big new thing is blockchain for ASX, and that potentially has a great catalyst for it to move forward. But that still is taking time and a lot of effort from ASX, and they're really just not getting there on that one as well. So for me, it's a hold. The dividend yield will stay there. I think it's going to be okay, but it certainly wouldn't be putting any fresh money into it at the moment.
Jun Bei, when you think growth stocks right now that are attractive, and I know that you've pointed to ones that are profitable, or you know exactly when they will be profitable, where is your thinking as to a growth company that you would be happy being invested in?
Look, I think the easiest is the healthcare at this point, because it's very defensive in terms of earnings. So people start worry about, the future in terms of recession and all that sort of worry. Healthcare is incredibly defensive, and many of the healthcare companies, like we talked to before, earning has been hurt by the COVID. So it's an easy reopening play as well. So healthcare is an easy space. With the tech space, I actually think some of them looks all right, but you have to be very careful that some of those tech are not too linked to consumer. So, because we know consumer is going through, well, not yet, but in the next 12 months, consumer will have some tough times in terms of discretionary pocket shrinking quite quickly. So just be careful that those tech, fintech is quite challenged at this point. Money's more expensive, harder to churn capital, and then if consumer go through some sort of crunch or spending less, directly flow through to their business model. Whether that business model will be sustainable or not, it's a bit harder. So stay with the big ones, stay with the ones that kind of don't require the economic activity to be really strong. Yeah,
you're not being tempted then by some of these big falls and the likes of, trying to think of some Life 360 or Nitro or any of that.
I quite like Life 360 to be honest.
But it's been terrible. Yeah. I think you've got it in the portfolio, don't you?
Yeah, so we got it in the portfolio, and I quite like that business. Look, it's one of those unprofitable business, so it's the same thing. But that one, because it's actually not linked to the economic activity, it's really about, that sort of, what do they call it, that kind of economy, tracking economy, is growing significantly. And then Apple has really significantly expanded that market. So, and then we've seen the latest data continue to expand and grow very strongly. So I actually think that one looks quite good. And then they got enough capital, they raised the capital, and they got enough capital to fund them. So, so I think that one actually looks quite interesting.
Yeah, it's down by 10.3% today. So potentially a buy for Life 360?
Well, I think it's very hard to say step in and buy. That's what we're saying. So when you look at the unprofitable businesses, for us it's easy. We're long short, so we can hedge on the other side. If I buy this one, I'll be shorting something that's unprofitable. As a long only buyer, because they're unprofitable, maybe you can chip away. When it falls 10%, you chip away. But just be mindful.
Got it.
I'm looking forward to Thursday next week, Xero reporting.
Yeah, that was another contender for stock of the day, but I thought since there was no news, we'd stick with the other ones.
So next Thursday, I think they're going to report really well. I think they're going to be okay. This isn't a business that is linked to the consumer. Yes, it is a part of businesses, but businesses need this no matter if they're doing well, bad, or good or bad or whatever. They still need to do their accounts, and Xero is one of those businesses that's entrenched inside many, many businesses going forward, Australia, New Zealand, and then the growth side of it in the US and the UK. So Thursday next week, we're going to definitely be watching that one very closely.
I think that's very interesting. A lot of us, we're all watching because it's such a high quality business. And, I think when it gets sold off like that, you certainly want to positioning, but the problem is so far, almost all the tech, whoever has reported, regardless of the result, have all gone down so far.
It's $88, less than $88 right
that's
now.
right. For me, it was $100 was the mark. So whenever it goes under 100, I'll start accumulating. But I think this result, will be good based on all the indication. The result will be good.
I bought some more at 90.50 the other day, and I thought I was a hero.
Yeah.
Went to 93.
That goes up. Yes,
and
that's
then
right.
it just smacked again.
Stay calm, Adam. Stay calm. Okay, look, I'll give you guys a bit of a break for now. Let me just update on our 7 stocks so far. Macquarie is a buy from both of my guests. Jun Bei says it always updates cautiously and guides cautiously. You're investing in this one for the future. Elmo, it's a buy for Adam Dawes at Shaw & Partners. It's an avoid for Jun Bei. Look, it's just a tough market to be in right now. All right, let's get to 7 West Media. Really split on this one. It is an avoid for Jun Bei. Oh, sorry, I just got distracted because I forgot Atomos. I'm going to rewind and go back to Atomos. So it's a hold for Adam Dawes, who has had a buy on the company. Look, he doesn't love what's happening right there, but he believes in the product going forward. It is a sell for Jun Bei. She said today is an expression of anger from an investor or investors, but she's not convinced. And it's not the place you want to be when it's in a downgrade cycle, and a little bit of uncertainty about what's going on at the company with CEOs in, out, and every which way. Let's get to 7 West Media and avoid for Adam Dawes. It's a buy for Jun Bei. Everything has a price, she said, and it's a good buy. Costs are out of the business. EM Vision Medical Devices for Linda. Again, Jun Bei's just asking, when is it going to be profitable? You don't want to be holding a company like this when you don't know when it's going to be making profit. She names CSL, she names ResMed as companies to invest in that space, as did Adam Dawes. He would be avoiding EM Vision Medical Devices. Worley, it's a buy from both of my guests. It's a table-thumping buy for Adam Dawes. ASX, Jun Bei says it's just expensive growth. It's expensive for the growth that you'd be getting with it, even on a long-term basis, Brett. And Adam says it's a hold. He's saying it's still paying a dividend yield. There's nothing fundamentally wrong with it. Not very exciting, perhaps, was the takeaway. All right, so this portfolio is a high conviction fund, and it is ultimately determined by our investment committee. So in the latest episode, well, it's up online. You can watch it yourself, ausbiz.com.au. The companies that we take from this program get put toward and in front of the investment committee, which then decide what's going in. In it, Tabcorp, Domino's, Ardent Leisure, Tyro, those were all added this month. And so we shifted some of the original allocations around, and as well the cash holding side. So prior we had 20% being held in cash. It's currently at 8%. Now the fund is down 2% on a cumulative return basis since its inception on March the 1st. Keep sending your requests. We'll keep putting it in front of our investment committee. If you've got some time this weekend, worthwhile catching up on that most recent episode.
Grab a beer, grab a glass of wine, because this is where we just gossip.
It has been easy to get this bull market wrong.
Cheers to you.
Have a great weekend, everyone.
The Last Call is brought to you by Australian Vintage Wines. Invest in the home of Australia's premium wine brands.
Welcome back to the program. Over the next few minutes, we will be covering Nick Scali, Auckland Airport, Pinnacle as well. For Luke, if you're watching to us, the ticker code is TUA for Riley, and HUM, HUM, which is subject of a takeover. So let's get to this list. Nick Scali, NCK. This one's for Abby. No context, but we do know that Nick Scali updated, reporting that net profit fell by about 6.6% in the period to 35.6 million, but it did see its gross profit margin for Nick Scali division rise by about 30 basis points. Jun Bei, I'll start with you. Furniture, in the most basic sense of the word. We know that the housing market is likely to slow. We know that through the pandemic we had such a tailwind for some of these home-related companies. Are the best days over for Nick Scali?
Yeah, look, it's interesting. It theoretically sounds like the best days are over, but the problem is they had so much supply chain issues that they couldn't actually deliver all these goods. So the pipeline actually is enormous, and one of the biggest reasons for the share price fall was actually they couldn't get the products ready, and so that's why share price really gone through some challenges. Now the latest, so we saw them just a few days ago. They talked to apparently ports in Asia, in China now started loosening up, so they started actually seeing shipments started coming through, and that is positive. So you should see, next 6 months, things should look still pretty good for this company. But however, like we said, share price investors like to look forward, and the forward looking certainly looks like consumer will go through a bit of challenging periods, and then the housing prices, while still reasonable, but in some areas we started seeing housing prices falling. And if we follow the indicator of New Zealand, house price down 6% on the national average. So it's actually quite significant after numerous rate rises. So is that what we're facing? It could be. So for the housing retailers, I think for the next 12 months, it's going to, but next 6 months will look pretty good in terms of earnings. But beyond that, I think share price will be quite challenging just because the forward looking is going to look a little bit tougher.
All right. Well, Citi has a buy on it. Macquarie has an outperform on it.
Yeah.
What is your view?
I've been selling this one for clients.
Okay.
Over the last month to 2 months, we've been sort of just moving out for that. All to what both of you have said, absolutely right. The other side of that is that it's not just Nick Scali, they've got Plush and they've got the online business as well. And the online business grew about 48%. So there is some glimmer of hope in there. But the overall arching period for this is that I can't see that the housing market is going to get any better. We know interest rates are rising. We know inflation's staying high and will continue to be there. The wealth effect is going to affect people. Do they buy a new couch? Potentially not. They might just sit on the old crappy one for the next 12 months and wait. So for me, I've been selling this one for clients. I just don't think you need to be there.
Got it. Thank you. And sometimes you just buy a new couch because you want a new couch, not because the old one's crappy, right? So it's one of those real discretionary purchases.
If you've got kids, it's always crappy. Yeah?
Oh, I have kids.
Yeah, so do I. So it's.
Yeah. We'll leave that one there. All right. My husband's like pedantic about our couch.
Oh,
There's
really?
no food on the couch, no drinks on the couch. Yeah.
Has he got the plastic over there?
He would if I let him.
Oh, really?
Trust me. Yep. Loves our couch. Anyway, we didn't buy it at Nick Scali. Auckland Airport, AIA for Cooper. Love you, babe. All right. So this is potentially a reopening trade. I mean, we know that visitors can go to New Zealand. They open their borders further to other countries. I can't remember the whole list right now. And it's an infrastructure play.
Yeah.
What do you think?
No.
Oh.
I'm not a huge fan of this one. It trades very expensive. It was always traded higher than potentially what it's worth. Yes, domestic travel is currently sort of 50% above their pre-pandemic levels, so it is starting to grow in the right area. I really love Sydney airports. That was my favourite, and it's all been taken off, and we made really good money out of it. But I just don't think Auckland Airports has the overall growth rate that Sydney has or did have. And for me, it would be an avoid.
If you had it, would you hold it?
No, I think it's too expensive.
Okay,
Yeah.
we'll sell that one
Yeah.
then for Adam. Okay, what do you think, Jun Bei?
I think I'm along the line the same way. It's always trading at that takeover premium. So people always have a view that because it's a small airport, you get taken out. So it used to actually always trade at a premium to the Sydney airport as well. And I agree with Adam. Like, we love Sydney airport, and unfortunately it's gone. And then, it's actually around the world, not many airports listed. So, this one will continue to trade at expensive rates. While things recovering, look, it's a lot you're paying. Now, and also do remember when, in terms of valuation for those companies, when the interest rate goes higher, which it is now, the discount rate that you use for those business, the long duration business, because they borrow a lot of debt against it as well, so the interest rate will go higher. So the return, the earning will actually become even more challenged, despite, there will be a recovery in terms of the volume. That type of asset in the rising rate environment normally will be under a bit more pressure.
Plus higher oil prices. So
That's
in
right.
other words, then
True.
everybody raises their prices on the, like Rex has already done $10. Qantas will raise their prices. Virgin, Air New Zealand will have to raise their prices. And these airports make it by bums on seats and people passing through the gates. And if there's less people passing through the gates because prices are higher, again, that's a negative for the business.
Okay, Auckland Airport is a sell. Pinnacle Investment, this one's for Luke. PNI is the ticker code. So Luke's saying, what do you think of it in the wake of its recent sell-off? Do you think that it could be a possible takeover target?
Well, Absolutely. Look, Pinnacle is probably one of the best, most diverse fund manager that's listed. Now, it's not just Pinnacle. All fund manager space has been sold off because the market's been challenging. In particular, Pinnacle, it's because it has a Hyperion, which is a growth manager, that has performed so well for so many years. Obviously, performance is a little bit tough because the growth company's been sold off. So investors was a bit worried about, what does that mean for future farm growth? They still managed to deliver a good farm uplift, which is very, very encouraging because, all thanks to, Ian's effort of diversifying the portfolio. They've got the Antipodes, the value manager, the
Ian McClellan, who's the CEO.
Yeah, that's right, which, he's done an incredible job. And I think at this price, yes, it still looks expensive because it's traded as a growth business. So I think it will continue. It needs to continue its farm growth. And at this point, it's still growing. And then now we're getting very close to the acquisition. So they've been talked about for quite some time, but because of COVID disruption, they couldn't travel. They couldn't travel to meet those managers offshore, apparently in America. I think that's probably coming through very, very soon.
What acquisition coming through?
So they've been talking about a big acquisition potentially in America.
To expand in the US. So you're not talking about Pinnacle being taken over. You're talking about it potentially taking over US.
That's right, because it's Pinnacle.
Haven't we seen other companies, fund managers do this and then come back with their tail between their legs?
Janice Henderson had a
Correct.
Correct. So for Ian, I think it's whether it's in the fund manager space or in other asset classes, right? So they bought into private equity, they bought into credit, they bought into bonds. Yep. So I think for Ian, he's talked to a reasonably transformational acquisition. He's been talking about it for so long. We're all waiting for it to come through, and I think it comes down to Ian couldn't travel, where the safety and things. And so now that when he can start travel, that acquisition is going to be very creative. It's coming through. So I think that's one that everyone's waiting for at this point.
Yeah, and I've known you long enough to know that you say in terms of fund managers follow the money, and so the FUM is still increasing.
Yeah, so they managed to generate FUM growth, which is very encouraging.
So is this a buy?
It's a buy.
You just got a fund manager to say it's buy on another fund manager.
That's right. So, but remember, I'm a long-short manager, so I play pair trade in the space. So
you short Magellan, you buy Pinnacle. Yeah, is that what you're saying?
Well,
she's looking at me to save her.
That's right. Well,
no, you've already shorted Magellan,
we
and
made
you
money.
made money on that.
Yeah, that's
so you
right.
don't do that, but then you short Pendle maybe because they're in the takeover sites, and I don't think that's going to go ahead. So
that's going to be tough, right? So because it's off script, and then perpetual price is falling, so it's going to be challenging.
Yeah.
And Pendle is the one that's quite exposed to the whole European space. Europe is going to go through some really challenging economic environment. So I think that space is going to be really, really hard.
Yeah. There you go. You got some insights into the portfolio, everybody.
Thanks, Adam.
Would you like to ask me?
Pinnacle Investment Management. Do you think it's a buy? Because that chart, indicates that there could be some value there.
And I remember when Magellan was absolutely getting torched, and Pinnacle was at $18. We're all like, "Wow, this thing can't do any wrong. Like this thing cannot do any wrong." Now down at $8, it actually looks quite interesting. Obviously, it is all about fund inflow, and it's all about insto flow as well as retail. Insto was up, retail was up only by sort of, $500 million kind of thing. So, but I think Magellan would love inflow versus outflow. So, where do you put your money? I think P&I is a good place to do that. I really like Jun Bei's comments on that extra allocation to the US and then bringing some more fund inflow. That's going to cost a bit of money. So I think you've got to be a little bit careful. I don't know how much cash they got and how they're going to do that deal. So that would be something that I'd be a little bit concerned about. But I think most of the street's got pretty much a buy on this one, and at about $8, even longer, I think this one's okay. So I'd stay with a buy on that.
Macquarie outperform, UBS a buy, Ords and Accumulate Morgans is an ad. That's all I've got in front of me right now. TUAS, TUA is the ticker code. This is for Riley. Thanks for writing in. What is TUA? That's the place to start.
Yeah, look, it's a split out of the TPG.
Correct.
And essentially, it's David Teo who founded TPG and done incredibly well. It's his vehicle. So he's the chairman. I think his son's on the management team and all of that. So it's essentially backing him creating TPG again in Singapore, purely Singapore play. Now, for 2 years now, they're over there. They have essentially be the lower cost sort of package over there. Singapore is a market where competition is extremely fierce. It's not Australia competition has been tough, but over there it's completely different. So in 2 years, I think they won 500,000 subscribers. I think they just reached that kind of break-even point in Singapore. Whether they can do it, it's really just whether you back David Teoh to do it again in probably one of the most competitive markets.
So do you?
I think it's quite tough.
Yeah.
I think it's quite tough. Much rather to play the domestic telcos, the likes of TPG. Actually, things are turning a little bit for them. Mobile market seems to be normalizing, and then they compare cycling some easy comps very, very soon. So that certainly looks a lot more interesting. And you're looking at growth next 12 months, whereas this one, it's a bit of black box. Even the disclosure is not great, so very difficult to get inside.
Yeah, I mean, and this is not particularly related, but even the man himself, David Teoh, was always a bit of an enigma. Never really gave interviews, never really came out and fronted in any way, shape, or form. So, would you back him?
So I own some of this stock. I personally. So I back David. I think he's a very, very smart operator. He owns 34% of this business. So I'm okay to hold it. I don't think it's a buy. I'm okay to hold it. I hold it myself. So disclaimers out there on that one. But I think that overall these guys will do really, really well because he does know that Singapore market. I think he's from Singapore or Hong Kong. Malaysia. So I think he'll do well. They have flagged some higher cost headwinds going through from rising electricity costs and some rebranding as well. Obviously, rebranding has been tough, but I think he's going to do okay in this one, and he's got the nous, he's got the know-how. So I'd be holding this one. In the Australian side, I've always Aussie Broadband. It got whacked the other day. Bit of a downgrade with the.
Well, and then it came out the next day and clarified, saying, "Well, put in over the wire acquisition because it was absolutely hammered." Yeah,
and that's my top pick in the telco space is Aussie Broadband. I really like it. I do own shares in that one as well. But, that one I think I'd be happy to get behind on the Australian side. So it's a hold for me.
Quick thought on Aussie Broadband?
A little bit expensive, and I think it was oversold, and clearly once they clarified, then it looks a bit better.
Over the wire acquisition is going to be really good for them.
Yeah, I think so too. So I think it looks interesting, but for me, at this point, I probably prefer a little bit low risk sort of play, which is TPG. You can go for the Telstra, but TPG give you a bit more, and small cap managers will start putting them into their portfolio, and this one will have a fair bit of momentum in terms of earnings upgrade. So I think that one is sort of of the size that will be quite attractive.
Yeah.
Okay, thank you for that, guys. Now I've timed it perfectly. Last on the list is Hum. Hum is for Henry, who says, I'm a shareholder getting concerned after it flagged more headwinds in its recent report. Is now the time to sell? I sort of, last on the list, didn't do a lot of looking into Hum. I know it's transitioned to BNPL. It was a profitable BNPL for a long time, but doesn't it have an offer on the table from Latitude? No?
Does it?
I don't know. You said that it was on takeover.
Yeah, because I wasn't sure. I thought I missed it. But I vaguely remember there was something. That was a few months ago. Was it a few months ago?
Okay, so shares saw an acquisition interest, so maybe nothing came of it. But
a stake was acquired. So that's the old Flexi Group. So it was a profitable business, unsecured lending, with all the retailers and the like, trying to transition into buy now, pay later at the wrong time. And now obviously not rewarded by that component of the business.
Yeah, like all those companies that rebranded as buy now, pay later, regretting that.
Just at the very top of the market.
Yeah.
So,
it's like a mining company going into a
online business
or an online business.
Yeah, online business.
Yeah, but it did put out its third quarter business update, I guess at the beginning of the month, and it saw volumes up 31.5%.
Yeah, look, it's a tough business. It's a very tough business. It's a very old school business, and it's tough. And all these, when they talk about headwind and things, they always had headwind. So for me, I think your capital is probably better invested elsewhere.
Okay. So it sold because I knew, it was driving me crazy. It announced the sale of its consumer finance business, HCF, to Latitude.
Latitude, right.
So that makes sense.
So they used to do, didn't they do radio rentals and
radio rental
TGO,
was
that was
Thorn
Group.
Thorn Group, and then it became something else. That got taken out by Latitude.
Right.
Yeah, radio rental.
Yeah, Latitude has been definitely aggressive in the market. For me, it's a no. if you're going to be in the buy now, pay later space, you want to stay in the top end. This has always been the third, fourth, fifth cousin inside of that. I think overall they've really tried to rebrand and do that, but it just hasn't worked. They did say that their net profit is going to be sort of, or maintain their guidance for around about that $10 million, and they're looking for a dividend of 30 to 40% payout ratio. Still, that doesn't really excite me, and there's plenty of other places to put your money. So no from me.
Okay, so there you go. That last one was for Henry. Henry hums a no. Okay, let's just recap the last few shares. So Nick Scali, it's a sell for Adam Dawes, who's been doing that on behalf of his clients as well. Jun Bei questions, really what's coming down the pipeline in this interest rate environment, what's happening with consumers and the reopening as well. Auckland Airport, Adam says it's just too expensive. It doesn't matter if it's a hard asset. He avoids it. He would sell it. Jun Bei agrees. It's always trading with a takeover premium, not hum. Oops. Hi, Auckland Airport. Pinnacles, this is a buy for both of my guests. We've had quite a lot of double buys coming through, Macquarie, Worley, and as well Pinnacle. And Jun Bei just talks about the likely, potentially transformational acquisition that it could go and do in the United States now. And it's a buy. You just think it looks interesting. Yeah, especially after its share prices come down. Yeah. To us, Adam holds it himself. He says it's a hold. He prefers ABB in that space. Jun Bei would rather go for a TPG because this is just leveraged to Singapore, and it's really just backing its founder, Dave Teo. All right, and Hum Group, you just heard it. It's a tough business, and it's an avoid. Guys, that was really fun. Thank you so much for joining us, both of you.
It's
Adam's
fantastic.
coming back for a drink at 3:45. You're welcome if you've got nothing to do, but
Next
I won't.
week.
No pressure. No pressure. Look, guys, thank you again, and thank you for sending in all of your questions. Please continue to do so. The call at ausbiz.com.au. You can also tweet. We got a lot of response when I asked for stock a day today. Ausbiz TV, or you can always tweet to me at Nadine Blaney, just my name, on Twitter. And if you'd like to look at that portfolio, it's ausbiz.co/portfolio. Now, don't go anywhere if you're interested in Atomos. Small Caps is coming up next. Dean Fergie from Cyan Investment Management has a view. He's going to continue that conversation about Atomos, where to from here, what's going on at that small cap. We're back in just a moment.